In this video, I'm going to introduce taxation. We're going to do this by covering types of taxes, what the current American income tax structure is like, and then we're going to talk about fairness or equity in taxation. So there are four broad categories of types of taxes. The first is a tax on earnings. The example of this in the United States is the payroll tax. So this is a tax levied on income earned on one's work. The main thing that goes to here in the U.S. is social insurance. The second type of tax is a tax on individual income. So this is a tax on individual income accrued during a year. This is different than payroll taxes. This is what you think of when you actually think of the income tax. And it's different than the payroll tax because it covers a broader range of sources, and it covers family income. And it does that, one example, is through the capital gains tax, which is a tax on earnings from selling capital assets. So payroll taxes, income taxes. Our third type here is tax on corporate income. So these are taxes levied on corporate earnings. And one of the things we're going to talk about in this and the next video both is this idea of you can't tax an institution, right? You can only tax individuals, and the individuals associated with that. We're going to get into that in our next lecture with tax incidents. Our fourth type is taxes on wealth. So this comes through wealth taxes, which is just any type of tax paid on the value of an asset. A good example of this is a property tax. So this is a wealth tax based on real estate value. Another type is estate taxes. This is a wealth tax based on the value of an estate left behind when one dies. So somebody passes away, whatever it is that they leave to their inheritors, that is an estate, and the government places a tax on that. That's an estate tax. Property taxes are collected usually annually based on the value, the way that that value is estimated usually by, in the U.S. case, or at least in Texas case, this is generally done by the county. So they have to estimate the value because obviously you don't have the market value every year for things that aren't sold every year. Okay. I don't know why that says 4. I think that should say 5. So forgive my poor counting. Is taxes on consumption. Okay, so this is a tax paid on individual or household consumption of goods and services. This is sales tax, right? So this is a tax paid by consumers, collected by vendors on behalf of the state at the point of sale. So, yeah, just your classic sales taxes here. An example, or maybe better to call it like a near relation, is an excise tax. So that's a tax paid on the sale of goods, but it's specifically applied to goods. Good examples of this are cigarettes or gasoline. So if you hear of things like sin taxes, that's talking about an excise tax. Okay, so it's real interesting to look at the different tax revenues by type of by the different levels. So look at the different level of government and how it collects tax revenue by the type. So let's take a quick look here. So your federal government obviously makes a bunch out of individual income, a lot of corporate, very minimal sales, and then these are of course payroll, right? So a lot of payroll, a lot of income taxes happens from the federal government, and then a good amount from corporate. Your state governments, obviously as mentioned before, property tax is a big one. Individual income, surprisingly large given that you don't think of state taxes as having a lot of income taxes, but they actually do. And then, of course, a big proportion made out of consumption tax. And then remember, these others are things like those fees that we were talking about from before. And then, of course, your total of your government. It's just a combination of these things, so it's probably about what you would expect. But notice that income tax in the U.S. is taking up a big share of tax revenues, or making up a big share of tax revenues. Okay, let's take a look at the income tax structure. First thing you have to do with an income tax structure is calculate the tax base, right? So this is done by taking your gross income, the total of an individual's income sources, and then adjusting that. So your adjusted gross income is your gross income less deductions. So examples of things that would give you deductions: retirement alimony, health insurance premium, payroll taxes if you're self-employed, etc. So that reduces the amount that you're going to pay taxes on. And then you have exemptions. So exemption is a fixed amount a taxpayer can subtract from your adjusted gross income for each dependent member of the household, as well as for the taxpayer and the spouse. I won't go too much into the income tax, like this whole discussion here, because we've got a lecture coming up or a podcast episode coming up that's going to go through how taxes really work. I just want to lay some foundational basics here. So what are these deductions? Well, your main type of deduction is what's called a standard deduction. So that's a fixed amount a taxpayer can deduct from their taxable income. And then you have itemized deductions. This is an alternative to your standard deduction, so you can't have both. And this is where a taxpayer deducts the total amount of money spent on various expenses, such as gift to charity, interest on home mortgage, etc. So you have to pick one or the other. For most people, the standard deduction is the way to go. Keeps it simpler, and you're not gaining anything by going to itemized deductions. And higher income people giving a lot to charity, etc. Those are going to be the people that don't want to take itemized deductions. Okay, so I wanted to set that up so that we could talk about an important topic, which is fairness in taxation. And to do that, we want to think about a couple of ideas in taxes. The first is your average tax rate. Okay, so your average tax rate is the percentage of total income that's paid in taxes. Very straightforward. How much do you pay in taxes divided by your total income? As with anything in economics, what is important for decision making is what happens on the margin. And so we want to think about our marginal tax rates. This is the percentage that's paid of the taxes of the next dollar earned. So why is it that that's the relevant decision factor? So if I'm making X amount of dollars, I'm making $50,000 a year, and I'm trying to make a decision, how many more hours do I want to work when I'm offered overtime? Well, it's not the average amount that I pay in taxes that's going to matter, right? Because as we're going to see in a minute, right, U.S. income tax is progressive, so the more you make, the more it taxes you. And so it's going to be how much of that money that I make, the marginal dollar, the next unit, how much of that am I going to pay in taxes? That'll be what's relevant to me making a decision about how many more hours or if I'm going to take more hours. So that, just remember, that's the relevant that's the relevant margin for decision making. Okay, so there's sort of too broad. We'll get into another in a second, but your classic fairness in taxes is two things, right? We'll call it vertical equity and horizontal equity. So vertical equity is the principle that groups with more resources should pay higher taxes than groups with fewer resources. So just more well off you are, the more you should pay in taxes. This is the basis for progressive taxation. The Concise Encyclopedia of Economics defines this just very simply: better off taxpayers should pay more in taxes. That's the idea of vertical equity. And it is normative. It is normative. The other type of equity is horizontal equity. So this is the principle that similar individuals who make similar economic choices should be treated similarly by the taxpayer. So both of these two definitions, this one, these are from Gruber, the Gruber textbook. And I quite like this one. This one was really precise. This one's not so good, but it's a working definition. It's okay. I like the simplicity of the way the CEE puts this. So horizontal equity says, okay, we shouldn't have a situation where people that are in the same category somehow pay different amounts of taxes, right? CE says this is equally situated taxpayers should pay equal taxes. Right? So people that are in similar situations, they should pay taxes. This is sort of the basic fundamental idea of fairness, probably, right? That there isn't some arbitrariness to the way that taxes are getting applied. It's not just whoever the government stumbles upon first pays the entire tax load, right? Which of course sounds silly, but if you think back to the way the governments might have been run in the past, there's a good chance it looks almost exactly like that. So, and I mean in the distant past. No comment as to the near past. Okay, Now, this, of course, is not as easy as it appears, right? One is, how do you judge whether two taxpayers are equally well situated, right? This matters for both vertical and horizontal, right? So somebody says, I have high income but low wealth, and somebody says I have high wealth and low income. How much should those two people pay relative to each other? Because if they're the same, then that has implications for both vertical and for horizontal. If they're different, then it matters on the vertical dimension. It's really hard to say, right? Like I think we have this personal sense of that's just like easy to think about because I can look at any other individual person and say, oh, they're more well off than me or they're less well off than me based on our income and what resources it seems like we have at hand. But then when you try to codify that becomes very difficult, right? So measuring the totality of how do you value income, how do you value wealth, how do you sum up all the different sources, right? Whether it's property or whether it's highly liquid, whether it's investments, whether it's all these number of factors that are going to be hugely important and going to make this whole conversation very, very complex. So even if we could determine where people are in their situation, we still have to ask the question, how much more should better off taxpayers pay, right? And there's three answers. There's three sort of approaches to this. One is progressive taxation, which is a tax system where effective average tax rates rise with income. So remember that average tax rate from before. We're saying the amount you pay on average, so the proportion of the total income that you're making. Well, obviously it could be more than, but it's easiest to think about it in context of income. It goes up. The total, right? The proportion of your total goes up, right? So this means higher income taxpayers pay more and pay more proportionately, right? So if somebody makes $100 and somebody makes $200 and we tax them both 10%, right? Then the first person pays $10 and the second person pays $20. Second person paid more, but they didn't pay proportionately more. They paid the same rate. But if we put a tax of 10% on the first person and they pay $10 and we put a tax of 15%, right? And so that next person pays $30, then they paid more and they paid proportionately more. So the rate has to go up. Okay, the main example of this, of course, is U.S. income taxes and their graduated marginal rates. So that the more income you make, the further you go up into the brackets, the higher marginal rates of taxes you pay. As your marginal rate, if it is increasing, then your average tax rate paid will be rising, right? So if you add a bracket of higher tax rate, then that will raise the average. Okay, another idea is proportional taxation. So this is a tax system in which effective average tax rates do not change with income, so that all taxpayers pay the same proportion of their income in taxes. So these are flat taxes, and it just says we take the same proportion of taxable income from everyone. So people make more, pay more in absolute value, but they don't pay more proportionately. So again, that's like taking 10% from both the person that makes 100 and from the person that makes 200. And then, of course, the last one is regressive taxation. So this is a tax system in which effective average tax rates fall with income. Sometimes when we're evaluating things that aren't income, we can think of some examples of regressive taxes. So if you have taxes on relatively basic needs, necessities, then you end up in a situation where you're effectively taxing at a higher rate for people for whom that makes up a higher proportion of their consumption. But yeah, it just basically it says people who are less well off, who are less well situated, pay more as a proportion of their income. Notice that they could still pay less, right? So somebody makes $100, we tax them at 15%, they pay $15. Somebody makes $200, we tax them at 10%, which is lower. They'd pay $20. So they're paying more, but they're paying proportionately less, the higher income person is. Okay, and this brings us to the benefit principle, right? So we've got vertical equity, which is saying, okay, the more the higher income that you're making, the more well off, the more well situated you are, the more you should pay. But that can sometimes violate, or really even often does violate, the benefit principle, which is the idea that those who benefit from government operations should be the ones to pay in taxes. This is pretty straightforward. We'd apply this as an idea of fairness reflexively in anything that isn't government taxation, right? If you and I are deciding to go in, we're gonna go together. We're gonna buy a lawnmower. We're neighbors, right? And we're gonna share a lawnmower. And you think I'll use it twice as much as you, you're not going to agree to pay 50-50 most likely, right? You say the benefit principle. This idea of fairness should be that people who use it and benefit more from it should be the ones that should pay more for it. Government services are often of much higher value to lower income people because of this way that they're utilizing those services than they are to higher income people. And so you're going to see a lot of value from the benefit principle perspective. You're gonna see that equity would actually demand results or tax systems that are contrary to what vertical equity would demand. I think as United States citizens, we're generally pretty accustomed to the idea of vertical equity, and we think it is fair that we have a progressive tax system like our income tax. But I mean, obviously, a lot of our things are flat taxes, like sales taxes, too.